Mark, Todd was outside the RBA with us yesterday. He's had more time to ponder that and ponderable. What have you concluded, Mark?
Good morning, Carson.
Yeah.
I think there's two sides to this, and don't think for 1 minute I'm an apologist for the banks. So the problem lies in, let's say they do pass on all these costs, and clearly the banks are in such strong positions. CBA is a $100 billion company. They have some great borrowing opportunities. The market looks to lend to people like that all the time. The problem for that is, in the event, well, the positive is if they pass it all through, we think it's stimulatory to the economy, and it looks to where the RBA is trying to pitch the economy. In the mining sector, if it starts to weaken, you'll see the construction sector start to pick up because they pass on these cuts. That makes a lot of sense, and that's a really good business model, and we'd like to try and support that. But in truth, the banks are unlikely to pass it all on because of a very simple reason. It's just the money it is to them. It's a huge amount of money. For every penny they can save, for every 10 points they don't pass on, they make enormous amounts of revenue. And when you look at the Commonwealth Bank as a $100 billion company, it's driven on the dividend streams it's prepared to pay. And so if in the event it can't get those dividends, we see pressure on margins with people not being able to lend. The banks are not seeing the credit growth, and the RBA spoke about that. They're not seeing the credit growth they'd like to see. Pressure on those margins will mean pressure on those dividends, and so you look for either A, productivity gains, which is code for job loss or offshoring, or you look for saving your margin on some of your spreads, and I think they'll be more likely to take the political hit by not passing on all the costs, all the savings, and they'll look to try and market it and saying, well, we're trying to keep the dividends up. So I think they won't pass it through.
On the issue of deposits was raised in that introduction. They still need to keep people in deposits and need to be offering decent rates, don't they? Because as global interest rates go lower and RBA rates potentially go lower,
absolutely,
it's going to be increasingly attractive for people to go into shares, for example, or other riskier assets.
I mean, that's a good point, Brooke. The point is that the deposit market funds a lot of these organisations, and APRA has wanted, and all the regulators have wanted through Basel III to increase the amount of deposit-taking institutions, so you're away from what they call the hot money. At the moment, they're offering people a 4% coupon, a 4% term deposit. You won't get anything with a 5%. So if you remember back in 2007, some of these banks were able to pay 10% for 5-year deposits. Those deposits are now rolling off, and people are reinvesting back at a 4% handle. If it goes into something with a 3, that would be very difficult for those people who live off those deposit rates, those very safe assets, and trying to get a 3%, 3.75 or 4% return is very hard to live off. So you'll see that pressure being pushed on term deposits if they start to pass through all those costs as well.
It's interesting, though, no mistake, that high-yielding dividend stocks always get a boost the more rates are cut. It would seem market consensus, would it not, that they're still on an easing bias, and what would swerve you away from that view?
They're clearly on an easing bias. It's just a function of timing. I think that the banks will know that at one point in time they'll have to pass it through, but the banks are paid good money to have the argument at a national level that they can't pass it all through. So they take a little bit of political heat and then wear 10 basis points. If they can keep that 10 basis points on some of these balance sheets, that's hundreds of millions of dollars in revenue. It's that sort of number. So it makes sense to try and fight, have a week or so of really bad press, but you've kept $300 million.
Michelle Hutchinson from Rate City saying we might even see lenders lower their rates out of cycle. What chance would you give that one, Mark?
I think it's unlikely, other than somebody like the NAB trying to do a divorce rate so that they go early with some sort of very targeted campaign. So that makes some sense. But to your generic 3, 5, 7-year mortgage, it'll be unlikely, unless it's some sort of teaser rate, that they'd want to take that cut themselves. I don't think they're like that. I mean, when the ANZ made the decision to step outside of the RBA cycle, it was really making the point that we'll run our business our way, and that was a real slap for the RBA. And I think it's clear that they need to be offering teaser rates, but that's just marketing.
Do you think part of the caution around that, in fairness, is that this job shedding looks to be hitting key parts of that economy that the banks would otherwise be looking to swim in, like retail, like manufacturing, like financial services? If those same said sectors start to wobble, you talk about margin compression, hello.
Yeah. Well, I think the thing that the RBA said in its document was very dovish, and it said the economies are actually potentially very soft. So it would make sense that if you're running a bank to say, I can see that data in real time, I need to be able to create some buffers to save some very difficult conversations. And all the news that we're seeing at the moment is saying that there's a suggestion there's weakness in the economy around the employment number, so they'll want to save as much money as they possibly can.
Mark, really quickly, can you just put the retail sales numbers into context then, based on what you just said, that we get 10 minutes away now, just checking the clock?
Yeah, well, I haven't got them. I think it's a driver. It's a huge number. The retail sales are very important to all these economies. At the moment, I thought the bigger number was the construction number. I thought that was where we were drawing. I think the retail numbers are not as important in that, we're seeing all the internet business build up. We're seeing a lot of the effects of that market rebalancing itself, whether it be a Harvey Norman, whether it be, all the JB Hi-Fi, all those sorts of organisations trying to get online. So I think that's not as important as what the construction numbers have been.
Perfect. Thank you, Mark. Mark
Thanks.
Todd from FIIG Securities. Appreciate it.